Good morning. We're going to start the Tax Increment Financing and Reconciliation webinar now. My name is Cindy Kendall, and I'll be taking care of a couple of the housekeeping matters before we turn the session over to Ted and Marlis. First of all, today you should have received one, possibly two emails with the links for the handouts and the slide presentation today. Using these links in your email will not require a password, so you should be able to view and or print those presentation and handouts. A few items about the sidebar feature used in webinars. Be sure to use the button which indicates if you are on a mic and speakers or on a telephone. If you have any problems, we're suggesting that you go to www.support.gotomeeting.com and click on the Contact tab, or you can call 800-263-6317 and they can help you with any technical difficulties. Due to the large number of participants today, we will be muting everyone during the session to allow the speakers to get through the material. However, there should be a chat feature on the bottom of that sidebar, and you can put questions in there, or you can email them to me directly at ckendall, K-E-N-D-A-L-L, at iastate.edu, and we will attempt to address as many of those as we can. Rest assured that we will be responding to each of those questions, and we will be posting a Q&A for the generic questions so that we'll be able to see those answers. So if you wish to minimize your sidebar now, you can do so by clicking on the little red arrow, and that will minimize it, and then we will turn it over to Ted for the presentation. Ted?
Thank you, Cindy. As Cindy stated, I'm Ted Nellison with the Department of Management for the state of Iowa. Also in the room with us is Carrie Johnson, also from the Department of Management, here to answer questions. Marlis Gaston from the Auditor of State Department will be handling the second portion of the presentation on some of the common errors. And Andy Nielsen and Sue Battani from the Auditor's Office are also in here to handle any questions that we get. Today we're looking to do a small overview of tax increment financing, how it works, and kind of what's the procedures behind it. We're also going to cover the Indebtedness Certification and the Reconciliation Forms that should be completed every year on December 1st in detail so that you will know how to fill those out. And then, as I stated before, Marlis will be handling a look at some of the most common errors and noncompliance issues related to TIF. TIF really began as a way to minimize blight and improve slum conditions, and also a way to spur economic development in areas that were more downtrodden. It exists in regions called urban renewal areas. Those must be created by a governing body for the levy authority before any TIF revenues are diverted. And the recent change, House File 2460, now states that a purpose must be outlined for, or designated for those TIF urban renewal areas when they're set up, and it cannot be redetermined throughout the life of the area. Slum and blighted areas can be set up with no horizon or no end date for when the revenues will no longer be diverted from the increment. Basically, they can go as long as it's necessary to accomplish the purpose. The economic development areas are more limited. If they were set up prior to 1995, they have no horizon, but after 1995, they are limited to 20 years or 10 years if it's a residential economic development area. How TIF works is that the urban renewal areas are established by the levy authority. Like I said, the levy authority at that point must designate a reason that they're setting, or a purpose that they're setting up the urban renewal areas to deal with. Once those are set up, an ordinance is passed by the levy authority to start diverting increment revenues to the TIF special fund that will also be set up. The county auditor then should get a debt certified to them for costs incurred on those projects, and then once they get that first certified debt, that's when they set the base valuation in the base year, and then start diverting the TIF revenues to the levy authority after that. And the idea behind TIF is that you have a base valuation, and as the projects create an increased valuation, that increase over the base is revenue that goes back to the levy authority or the TIF authority in order to do more projects in the area and pay for the costs of the projects that are being done. The way that happens is that the consolidated tax rate that's applied against the increment by all levy authorities minus the debt levy, the amounts for debt levy, ISL, and PEPL are diverted back to the TIF authority and used to repay debt that was incurred for projects. All of the revenues that are collected off of this increment should go into the TIF Special Revenue Fund set up by the TIF authority and used to repay certified debt. Should not be used to set up a fund for projects in advance, only to repay debt that's already been incurred for projects. The next slide is just a visual representation of what that looks like. We used an economic development TIF for this slide just so it has an end date. So what will happen is once debt has been certified to the county auditor, a frozen base year is established, and this frozen base is the amount of valuation that all levy authorities in the area can still tax against and gain revenue from. And as projects are completed and valuation grows, you get what's called the increment, and that's any valuation above the frozen base number. That is all revenue that goes back to the TIF authority in order to repay debt for projects. And then once you come to the end of the 20-year economic development TIF, all of that valuation gets re-released and can be taxed by all levy authorities. The TIF certification process is really a four-step process. What you do initially is that you incur debt within your urban renewal area for projects. And the ways that you can do that are through interfund loans, through taking out of bonds or notes, or through rebate agreements or developer agreements. Once those debts have been incurred, they get certified to the county auditor as TIF debt, and the county auditor starts to divert revenues back to the TIF authority in order to repay those debts. The amounts diverted are going to be the maximum unless you specify otherwise on a yearly basis. So the county auditor will take all of the TIF revenues that come in a year, give them back to the city until they reach their amount of certified debt. And it's up to the county auditor to make sure that not more than the amount of certified debt gets paid in revenues to the levy authority. And then once those revenues are received by the TIF authority, they should use them to repay debt that is outstanding. We have a couple of scenarios just as examples of how a normal TIF certification process would work. First, you would borrow the dollars through an internal loan or from an external bond or note sale. The proceeds would then be placed in the capital projects fund for expenditure on the projects within the urban renewal area. The projects would then occur and be paid. The expenses would be paid from those bond proceeds out of the capital projects fund for authorized TIF projects only within the urban renewal area. All of the funds that come from an urban renewal area are restricted to projects within that urban renewal area. On December 1st of each year, the new debt that qualifies for TIF revenue reimbursement then gets certified to the county auditor using the forms that we're going to be going over later in this presentation. The county auditor then divides the increment valuation revenue and gives the portion to the city or the county that's the TIF authority. They put it in their TIF Special Revenue Fund and start to repay the certified debts, and then debt is eventually repaid in full. A second scenario on that would be if you did a economic development grant where you have an agreement set up ahead of time where you have monies dispersed in the form of economic development grants to a grantee. Those have to be authorized by the governing body of the TIF authority in order to be considered certifiable debt for TIF reimbursement. The disbursement they should all be identified to the voucher level, meaning that each individual grantee and the amount that they get should be tracked and approved by the governing body in order to get it certified as TIF debt. Again, on December 1st, you certify the TIF debt to the county auditor. They make the appropriate changes to the incremental valuations that are being diverted to the city. The city collects that money again in their TIF Special Revenue Fund. The revenues that come from TIF should not be commingled in any other fund. All of them should always go to the TIF Special Revenue Fund and be set aside only for TIF-related reimbursements. And then, again, you would repay the grant money from this fund once the TIF revenues have been collected. First forms that we're going to deal with are the TIF certification forms. These are the forms that you use on a yearly basis to certify any new TIF debt that has been incurred by your authority. Those are located on our DOM website, which the address is shown on the slide of www.dom.state.ia.us. That'll bring you up to our main page. On the left-hand rail, there's a link called Local Budget and Finance. You hover over that link, and it'll bring up a slide-out menu. On the slide-out menu, there's an option called TIF Forms. Clicking on that will bring up the TIF Forms page, and the top set of forms are the city and county indebtedness certification forms. It's necessary to use the appropriate forms for your levy authority. If you're a city, obviously use the city forms. If you're a county, use the county forms. The first form on the, I'm using city certification forms just to be a solid example the entire way through. The first form is Form 1, which is the general information form. First thing you need to input on this form is your city information and your urban renewal information. One of these needs to be completed for each urban renewal area that you're certifying debt in a year. So if you have 5 urban renewal areas and each of them has a new piece of certified debt that needs, or a new piece of certifiable debt that needs to be certified to the county auditor, you would do 5 separate forms, one for each urban renewal area. In this case, it's just one urban renewal area in the city. So I just put in the urban renewal area name and the urban renewal area number. That urban renewal area number should be given to you by the county auditor once they establish the taxing districts for that urban renewal. The bottom portion is an auto-filled summary amount for all of the information that you're going to be providing on following pages. It'll auto-update, and it is a formula, so no input should go into that box as you fill out this form. It'll auto-update from the information you put in later. On the bottom half, there is a section where you can put in any notes that you deem relevant to help the county auditor properly administer your area or your pieces of debt. When you enter certifiable debt on the other pages in this form, there are spaces to provide instruction, but this just gives you another space where if you have some general instructions or some general information about the area that you think will be useful to the county auditor, you can put it up here. Also at the bottom, upon completion, you should sign, date, and put a contact telephone number for the county auditor so they know who to contact if there's any issues with the information contained in the form. The indebtedness certification process is fairly simple. The first form that you complete is Form 1.1. This is just for new debt that has not yet been certified. And what we're certifying on this form is total amounts of principal and interest. So you would want to do the amount of principal and interest that would pay the loan or pay the bond to paid in full status. The form 1.1 looks like this. We're going to be using it in pieces, so I just want you to get a look at what the total form looks like, and then we'll break it out into the various pieces of it. First piece is the information that will auto-populate from Form 1. This is, again, just signifying what urban renewal area you're dealing with for which city and which county. The second piece is where you input the actual details of the newly certifiable debt. In this case, I set up a sample bond and a sample rebate. They're handled a little bit differently. The sample bonds, you would put in a descriptive title for it. Generally, you can just put in the title that's on your official statement, and that will suffice. Designate whether they are general obligations or if they're revenue obligations, and then put a title that will allow you to link back to them in the future in order to track the amounts that have been paid for this piece of debt. The next piece that you put in is the date that the debt was approved by your governing body. So in the event of a bond sale, it'll be usually the sale date that goes on the bonds themselves. The rebates, it's also the date that the governing body just approves the rebate. The total amount or in the total amount space for the bonds, you can see it's principal and interest total to pay the bonds in full. And then on the rebates, rebates are generally just principal, but again, if there is interest included, you'd want to include principal and interest. With the rebates, there's a checkbox at the bottom that you want to check to show that it's a rebate agreement, just so that it can be properly tracked by the county auditor. On the rebate, I showed that there's this space to provide instructions for how this debt is to be handled. In this case, it's a rebate agreement with a yearly maximum and a maximum total cap, so that it gives instructions to the auditor as to what to look for. They're only going to be laying aside $25,000 a year max for this rebate. Form 2 on the certification forms is the amount that you want to modify for a yearly payment. Form 2 gives you the option of, since on Form 1.1 you've already entered the total amount of principal and interest, if you don't use Form 2, the county auditor will divert as much revenue from that area as there is in a year until you've met that maximum of principal and interest. If you want to divert less revenue per year, thus giving the either to match your debt schedule more closely, or if you want to use more of the TIF area revenues for your general fund, then you'd use a Form 2 modification to modify the amount yearly, the amount that you receive yearly down. This is done by including the same information essentially, as far as you input the city and county and urban renewal area and urban renewal number. And then on the bottom portion, you put in the information for how you want your disbursements to work. So in this case, I'm stating that there is a rebate that only needs $25,000 in this year, rather than the whole $250,000 that you saw was certified on the previous form. It'll only divert $25,000 worth of revenue to this particular piece of debt. It won't divert anything above that. Also put in another rebate below that had existed previously, where that only gets $10,000 a year. So for those rebate agreements especially, or for pieces of general obligation or revenue debt, you can set up a yearly amount that you'd like to receive if you want to match your debt schedule and make it easy to track, or if you need to release more of that increment back to be taxed for your general fund revenues. That's a good way to manage that. TIF Certification Form 3 allows you to decertify debt. The reason that you would decertify debt, the most common reason, is if you have funds being diverted every year in the total amount of increment revenues, you'll be running a balance in your TIF fund, more than likely, just due to the timing of when you pay your debt. Usually there's a debt schedule attached that you cannot pay early, so you'll have to allow those funds to sit in your special revenue fund until their call date comes up. So you'll be earning interest on them most likely the entire time. That amount of interest at the end should be decertified so that you don't get more in increment revenues than you have in debt. Also, you might have reductions due to a sale of property within the urban renewal area that brought in some money that was used to pay debt, or you could have gotten a grant or some other form of outside funding that reduced your debt. Anytime you have a reduction in certified debt, you should also have a decertification, just to let the auditor know that less TIF revenue is going to be needed to satisfy this debt than was originally stated. Form 3 works very similar to Form 2. Again, you just enter the identification information at the top for the urban renewal area that you're dealing with, and then at the bottom you simply put in the amount that the debt needs to be reduced. In this case, some outstanding 2010 GO bonds need to be reduced by $250,000 due to payment from an outside source. The auditor's role in the process, as I've stated, is they track the debt that's certified against the amount of revenues that have been diverted to the TIF authority. The auditors should be filling out a TIF Reconciliation Form on a yearly basis along with this certification of debt. Any new debt that you have should be certified every year to the auditor by December 1st. That's an important date so that they can get that TIF reconciliation form completed and back to you. If your county auditor is not getting you a reconciliation form each year, you should ask them about that. It's good for both the auditor and the levy authority just to make sure you're on the same page as far as how much has been received and how much is still outstanding. There are two separate types of TIF reconciliation form. There's one for a urban renewal area that has no segregated rebates, meaning that it doesn't have any rebates that are tied to specific tax districts for revenue. And then there's one that allows for rebates to be segregated out to specific districts. Again, these forms can also be found at the DOM website. You get to it the exact same way by going to TIF Forms, and it's the second set of Excel spreadsheets that you'll see on the page. The top one is for without segregated rebates, so that'll be missing the rebate pages that will be in the bottom one. For the purposes of this demonstration, I'm using the segregated rebates reconciliation sheets as they are a little bit more complicated and have a couple of extra forms that need to be completed. The first page of the TIF reconciliation form is the instruction page. This gives you a place to input the identification information for which urban renewal area you're working with and tracking. The bottom half of this sheet, and again that goes at the tops on the top. The bottom half of the sheet is a summary of the reconciliation information that's going to be put into the back of this form. It auto-populates again from forms being filled out in the indebtedness and revenue sections of this form. The first page that you'll deal with will be the indebtedness page, and again this should be filled out by the auditor, and then it should be double-checked by the authority. The indebtedness page autofills for the information about the urban renewal area, and then the space below is for inputting all existing certifiable debt. So anything that has been certified to the county auditor for this urban renewal area should be listed here on a yearly basis, and it should be updated to include any debt that is newly certified or has been certified in the past couple of years. So this should just count as a running total of all of the debt that has been certified in the area. Sometimes you may see a summary. The auditors in 2007 just kind of did a summary of debt that was certified prior to 2007, so it may say something similar to debt previous to 2007 and just have a total and not actually outline the pieces of debt. That's okay as long as they can show where those came from. Otherwise, it should be listing individual debts and their total amounts certified, along with any decertifications as well. So if you've decertified debt at some point in the past, they should also be listing that on this page so that you'll have some positive and negative numbers. And the information for this particular sheet can be found on the Certification Forms 1.1 and Form 3. And then if you have rebates that have been developed to use a specific tax district's revenues, those need to go on a separate sheet. Otherwise, if it's a rebate agreement that is just tied to the urban renewal areas revenues, you can put those rebates in here if they're not specific. Otherwise, you have to fill them out in a separate area. That'll be a form to come that's specific to segregated rebates that draw on revenues from a specific district. The second pages, or the following pages, are to track revenues that have been diverted by the auditor from the increment to the levy authority. Again, the fields will autofill for the identification of which urban renewal area we're working with. The spaces provided below allow for a yearly tracking of how much revenue has been diverted in a fiscal year to the TIF authority. So this is just a historical tracking of how much revenue has been applied against certifiable debt so that the county auditor does not give too much revenue to a TIF authority, so that they stop when they've met the certified debt that's existing. And again, that last form was just for previous years. There's a separate form that'll be for the current year, which is the one showing right now, and then the next form will be for the next fiscal year that's being certified. So in this case, this form would be for anything up through 2012, fiscal year 2012. This would be for fiscal year 2013, since that's the fiscal year that we're in. And again, it gets filled out the exact same way as the prior fiscal years. You're just dealing with the one fiscal year of 2013 and how much revenue was diverted in just this year. Again, it'll be auto-filled for the identification, and then the bottom half should be filled out the exact same way. You want to make sure on these that you're tracking it by tax district and not just in total, so that you know how much is coming from each tax district within the urban renewal area each year. And those reports should be something that the auditor has. And then again, as I stated, the tax projected for the next fiscal year, or the year being certified, which is 2014, should be entered on this next sheet. And that just allows for an easier tracking, because the projected amounts might change, but the amount projected should be the amount that gets used when the reconciliation is done. And again, it's entered the exact same way as the previous two forms. It'll auto-update your information for identifying the urban renewal area, and then you enter the individual tax districts and their revenues diverted for the next fiscal year on the bottom. If the area has a specific rebate that's tied to it, the revenue source of a specific tax district, some of these, an example of this might be if you have a specific property owner within that tax district that is being rebated their property taxes back to them on a straight rebate, you would only want to rebate them money from the tax district in which they reside. That's where the rebate forms and the segregated reconciliation form come in handy. Just allows you to track more closely for a specific rebate and in a specific district. Again, that can be downloaded from the Department of Management website. You want to be careful as to which one is being downloaded. There's an area without segregated rebates, and then there's the area with segregated rebates. In this case, you'd want the area with segregated rebates so that you can put in the rebate information individually. This form is going to be a consolidation of the previous forms that we went through for the general debt. It'll have a space for all of your rebate indebtedness for the specific district, and then it'll have spaces for your past, current, and future revenues to be input. The first space is the space allotted to the indebtedness. In this case, you would just put in your rebate that's tied to this district. It could be multiple rebates tied to this district. In this case, we're just stating that there's one rebate tied for $150,000 was the original maximum amount, with $10,000 per year maximum that could be diverted. The middle portion allows you to put in all of your prior fiscal years diverted revenue amounts. In this case, you can see since the $10,000 maximum, it just diverted $10,000 every year up through 2012. And then the bottom portion allows you to put in the current fiscal year, which is 2013, and the amount diverted, and then the next fiscal year, which is 2014, and the amount that should be diverted during that fiscal year. And then you get a total at the bottom of the amount of indebtedness remaining after all of those diverted revenues. All of this information will flow to that front instruction page, the summary at the bottom. As you can see, this totals up all of the indebtedness that's been certified, both in segregated rebate areas and in general, and puts that total up there against the amount that has been apportioned to the TIF authority for past years, the current year, and then what's expected to be apportioned in the next fiscal year. and then it gives a total of certifiable debt or certified debt that's outstanding that can still have the revenues diverted for it. So in this case, it shows that in general, in non-segregated areas, there's $1.9 million in certified debt still outstanding, and there's $315,000 in segregated rebates still outstanding. So that's the amount that would have to be diverted from the increment before all of the certified debt would be paid down. And obviously this will change from year to year as new debt is certified. But it should be done on a yearly basis to get to this point, the final summary, so that everybody knows exactly how much is left to pay, and that not a penny more than is outstanding in certified debt gets diverted from the tax area, from the TIF area. I'm going to hand it over to Marlis Gaston of the Auditor's Office for some common TIF errors and omissions that they find from year to year.
Good morning, everyone. As Ted indicated, I'm Marlis Gaston, and I'm with the State Auditor's Office. I'm glad to be here with you today and glad to see so much interest in learning about the TIF forms and the information that we're here to share today. My mission for the next few minutes is to share with you, from an auditor's perspective, some of the more common errors that we find as we're out auditing your TIF funds and your TIF certifications. Some of those things that we tend to see happening across the state, city to city and county to county. So TIF, just by its nature, tends to be one of those areas that is at higher risk for errors. And it's an area that most auditors kind of flag as an area that needs to be looked at. TIF law is complicated. There's a lot of requirements in TIF law, and it just really lends itself or leaves it open for errors. So not necessarily intentional errors, but just not understanding the way to certify or what can be certified or the form of debt, that type of thing. So we'll walk through some of those, and hopefully you'll walk away with some things to think about. Maybe think about how what we talk about applies maybe to your cities and how you may be doing things in your counties. Some of you may know, some of you may not know that the new legislation just passed in the 2012 session requires that any municipality that establishes an urban renewal area and intends to or does use TIF revenues to repay debt incurred for projects, you are required now to certify your compliance with TIF law. So, and those of you that are audited annually, your auditors, the statute now requires that your auditors audit your compliance with the TIF law. So if you're not accustomed to your TIF being looked at real closely, I'd say stand by, get used to that, because all auditors will be looking at that a lot closer this next audit round. So with that, hopefully we can share some things with you that you can think about in terms of how you're doing things and compliance or not. So starting on slide 37, the next couple slides I've just really listed kind of a bullet list of common things we've found. They're not really necessarily in any particular order of importance or anything. They're just items we've identified that we think would be good to share with you. So we'll just kind of walk through these. I'll talk more about some than I will others, but remember that at the end of the session we're trying to leave some time to address your questions. If we don't have time to get to everything, we will certainly get back to you in some format. So please be sure, if you need clarification or you have a question on your specific city on how you're doing something, we promise we won't send the TIF police out after you. We just want to, this is just a kind of, so we all kind of get on the same page and make sure that we're doing our TIF certifications and dealing with our TIF dollars properly. So So looking at the first bullet, not using prescribed forms, I'm not sure that really meets a list or the requirements for an error. It's not really an error. Statute doesn't require that you use the forms that Ted just walked through, but you do have to use something comparable. You have to use a form that includes all of those elements. And so we strongly encourage the use of those forms. They pretty much walk you down the path of compliance. There's pretty good instructions. Ted just went through how to fill them out. They're fairly easy, user-friendly, I guess. So we encourage that. It helps you comply. It also helps provide some consistency. So we're all looking at the same forms. So year to year, when you fill these forms out, you're filling out the same information in the same format. Your county auditor, who's getting lots of forms from different municipalities, they're all getting the same forms and seeing the same information, and your auditors are all. That's consistency can only help us all understand TIF more and make sure that we're in compliance. So we would strongly encourage that. The second bullet talks about not creating debt for the use of funds. Ted indicated earlier there's a four-step process to debt, and the first step in that process is to incur debt. And so this is probably one of the more common problems that we see is, and I'll just kind of explain it through an illustration. When your city clerk or the city administrator or the county auditor, whoever prepares the TIF certification, you'll sit down in November before it's due, December 1, and you'll pull out invoices, you'll go back to your general ledger, and you look at all the costs that you've paid from various funds. It could be the general fund, it could be an enterprise, a water or sewer fund where you paid some costs for a development that's within your urban renewal area. It could be the TIF fund, it could be some legal costs and things like that. And so you're looking and you're picking up those costs from the last certification date to your current certification and adding those up by fund, and then basically taking those costs and dropping them into your certification form. And the problem with that is the only thing that we can put on Form 1 to certify is debt. And at the point that you're just pulling costs out of your general ledger, those costs don't represent debt at that point in time. What really needs to happen, the proper way to deal with that, is as you're sitting down and you're gathering all of your costs and you're adding things up to the voucher level that each fund paid for. One of the forms of debt that Ted indicated is allowable from TIF is an interfund loan. And that's essentially when you're paying these costs out of those funds, and the intention is that you would reimburse those funds with TIF revenues. That's really an interfund loan. So what should be happening is those costs should be dropped into a resolution, a draft resolution for council approval that approves those costs as, you know, that they were allowable, they were spent on projects that you have going in your urban renewal area. It's the council or the board's intention that those costs be repaid with TIF, and therefore they approve those as interfund loans. That creates your debt. That resolution becomes your debt instrument, and from there you can drop those interfund loans onto Form 1. It gets you to the same place, but it helps you comply with that step 1. That's the point at which you're incurring debt, when your governing body actually approves those costs as debt. So you drop those into your Form 1, and the date the council or the board approves that interfund loan resolution, that's the approval date that you put on Form 1 for approval of that debt. So if if you have that process in place and you're just certifying your costs, make sure that you take a step back and get that debt created before you're certifying on Form 1. All right, the next bullet says excess TIF balances. Really a couple things that I wanted to cover with this one. one thing that I try to do when we're out doing audits of our governments that have TIF is I've tried to encourage the financial folks, the governing bodies, to view your TIF fund as you do your debt service fund, because essentially that's what your TIF fund is. The process for your debt service fund is the same as TIF. You issue general obligation debt, you levy a debt service levy, you collect it in your fund, and you make your principal and interest payments on your GO debt. Same process for TIF. And the balances in both of those funds are obligated to pay the debt that you've certified. The biggest difference between your debt service and your TIF funds, typically in debt service, you are only levying in any year what you need to make your principal and interest payments for the following year. So you're not really building typically much of a balance up in your debt service fund just by the nature of how you levy. On the other hand, your TIF fund, your urban renewal areas can generate TIF dollars much faster than you need them to repay your debt. So if you're not filling out Form 2 that Ted walked through and only asking for the TIF revenues that you need to meet your debt payments on your debt schedule, then you can be building up a balance in your TIF fund. But I want to emphasize that a large balance in a TIF fund does not equate to excess dollars that can just be diverted and used for any purpose. And this is something, one reason we try to get everyone to think of your TIF fund as your debt service fund, because sometimes you get a large balance in that fund and council members, different individuals don't realize that it's obligated for debt and they may think it's available for other purposes when it's not. If you do have a large balance in your TIF fund, certainly allowable. You can collect the TIF dollars as fast as they're generated. There's nothing that says you can't do that. But you may want to take a look at those balances and think about maybe even talk to your bond counsel what's the best way to deal with that. Some entities will take those balances and pay their TIF debt down as quickly as they can if it's callable. Other entities, we have seen cities that will actually borrow from that balance. If you have a project that you're planning to do and the council doesn't want to go to outside borrowing to save costs, some cities will borrow from that fund. Again, that's not something as auditors that we encourage be done, because you think about your debt service fund, I'm not sure there's a council out there that would even consider borrowing from your debt service fund balance, but and your TIF fund balance is the same thing. Those dollars are obligated. So, but it can make some sense if you're trying to save some money and you do have a large balance there. But I would strongly recommend if you're trying to make those decisions, maybe work with bond counsel and see what's the best option. It's a local decision. The second issue with excess balances I just want to touch on, if you have a TIF fund and all of your debt is paid and you have it's not an active urban renewal area any longer, statute now requires that balance in that TIF fund be turned over to the county auditor to be reapportioned as normal taxes. So you can't just take that balance and use it for any other city purpose. It's required to be turned over. If the fund has no necessity for existing any longer. If you have an urban renewal area that's still active and possibly have some projects on the horizons, going to be incurring some debt soon, you may want to consider, and this is another thing we would encourage you to talk to your bond counsel and find out from them, get their help, what should you do with that balance, because an option could be that if you're going to be incurring debt shortly, it may make sense to hang on to that balance, and when you incur that debt and you certify that debt, you reduce what you have on hand from that certification, thereby using up that balance for an allowable purpose in your urban renewal area. Okay, the next item, unsupported TIF debt certification, that's just what it sounds like. One thing that we find fairly often when we're out there and we ask for a certification form that from the fiscal year we're auditing, and we ask for support, there are cases where there is no support for what's on that form. Everything that goes on your TIF form should have some sort of debt document that supports it. There should be some agreement. So be that a general obligation resolution, a TIF revenue bond resolution, a rebate or development agreement, and interfund loan resolution. Something, there should be a debt instrument that supports everything that you are certifying on your Form 1. And it's important that you are able to support those amounts, because if your auditors come along and they find unsupported information, chances are they're going to be recommending that those dollars get decertified on Form 3. If they can't be supported as legitimate debt, then the alternative is to decertify them. And then along with that, make sure you're accounting for your outstanding debt balances, and that TIF Reconciliation Form the auditor can help you do that to some extent. So if you're working with your county auditor with that form every year, that will help you maintain accountability for the balances of all of your debt, including your interfund loans, making sure that you track the initial loan, what's been repaid, and what those balances are. The next item, using TIF revenues for things that don't necessarily meet the definition of a urban renewal project. A couple things that we see here. One example is where you may have a project you say issue general obligation debt for. Well, maybe only 80% of that project falls within your urban renewal area and 20% falls outside of that area. So logically, if you are going to certify the general obligation debt, you can only certify 80% of the principal and interest on that debt. The other 20% has to come from other revenue sources, likely a debt service levy. So make sure, that's one of the things that, as you know, especially in smaller cities where there's turnover of clerks or council members, and some of that history of when the debt was issued and how the city intends to repay it, which dollars, some of that can kind of get lost. The history gets lost as there's turnover, and it may have been, that GO bond may have been certified for TIF repayment from TIF revenues. New council comes in, new clerk comes in, didn't realize that, you may levy a debt service levy against that, and so that, you know, that's another issue that can come when you're dealing with projects that are partially in and partially outside your urban renewal area. So just things to think about. The other thing that we find within this bullet is the purchase of equipment with TIF revenue, and this is an area where if you are thinking about purchasing equipment with debt that you've incurred to be repaid with TIF, this is an area that you really need to get with legal counsel to make sure that the equipment you're purchasing would meet the definition of an urban renewal project. I think that a lot of the things that we've seen out there, the legislature probably didn't contemplate would fall under that definition. So make sure, not to say that there aren't things that do. There are situations where a piece of equipment might, if it's used strictly in the urban renewal area for a project and not used for any other purpose. But that's a legal question. So before you would make such a purchase, you need to get with legal counsel on that one. All right, the next bullet, certifying debt before it's incurred. The only thing you can put on your debt certification is an obligation that your city has. So, for example, something that we have seen is, you know, maybe you're getting ready to fill out your TIF certifications due December 1, and you know that the council has a project planned. They're going to be issuing debt, say in January or February, for that project. You can't certify that debt that December because it's not an obligation. Even though you know that the plan is there, if it's not an obligation, it can't go on Form 1 yet. So just make sure that everything on Form 1 is an actual obligation. The other aspect to that, we have seen in a few cities where you know you have a project coming up. Maybe you're going to borrow internally for an upcoming project, maybe from your general fund and from some of your other funds. And so we've seen entities that will certify projected costs for those so that you can, the intent would be to collect those dollars, you know, sooner so that you can pay those costs as they come about. But that's not how TIF works. TIF, you have to incur the debt, pay the expenses, and then you have to pay yourself back. So no projected or anticipated costs or debt allowed on Form 1. The last bullet on this slide is recertifying previously certified debt. We don't see this as much as we used to. The statute's pretty clear that you certify debt one time and one time only, and that makes it a requirement of the county auditor to divide taxes and repay the TIF revenues to you as a taxing body until that debt is paid, till the maximum amount of that debt is paid. So no need to recertify debt, and certainly not allowable. All right, the next slide, I guess we're on slide 40. The first bullet there, annually appropriated debt, I always like to talk about this one through illustration. I think it's easier to understand. So I usually give the example of, let's say that your governing body enters into a rebate or development agreement, say in October. And the maximum payout on that agreement, let's say it's $100,000. Well, if the body of that agreement includes what's called annual appropriation language, then in October when that agreement's signed, that $100,000 does not become an obligation to your government at that point in time, because that annual appropriation language, what that means is that when not until the council or the governing body appropriates what they're going to pay to the developer in the next year, until that happens, that doesn't represent a true obligation that you can certify. So an annual appropriation language, in the more current rebate agreements that we see, it's pretty clear language. It clearly says will be annually appropriated by the city council or by the Board of Supervisors, but it's not always that clear. So if you're not sure, if you have an agreement that has that language, make sure that you're contacting bond counsel to help you work through whether that's language is in your agreements. So what would happen, what we typically see for cities that do handle this correctly, is in November, before you do your Form 1 certification, your council would approve, or your board would approve a annual appropriation resolution, and they can approve the annual appropriation for one or more rebates in the same resolution, and they would appropriate in that resolution what they estimate they will pay to the developer in the next year. So say that's $10,000 with the example we have. So then on your December 1 certification, you can certify $10,000 as debt. That represents an obligation to your city. On the other side, if the annual appropriation language is not in your debt agreement, it's not in your rebate agreement, then when you sign that agreement in October, that $100,000, it really does represent an obligation at that point, the entire $100,000 to your entity. And those are always estimated amounts, usually, but at that point you could put that on your December 1 certification because it certainly represents an obligation. But most cities are careful about when they actually certify that type of debt, because the clock sort of starts ticking when you first put that on your certification form, and you only have so many years to collect on that. And many agreements that we see, the payments don't start for a couple years. So you may want to think about when it's best for you to certify it. But it certainly is an obligation when you sign it in October. Okay, the next item, levying debt service levy for general obligation debt and certifying that same debt as TIF debt. This can happen. I guess one way that we typically see this is we'll come into an entity and we'll see that they have this large debt service balance, which really typically shouldn't happen. We've seen cities with a couple, $200,000–$300,000 balances in debt service funds, and so we kind of step back and say, wait a minute, something's going on here, and oftentimes it's related to TIF, and it's a situation again where maybe there was some turnover, something happened, and maybe no one realized that that general obligation bond was certified for TIF, and someone's levying it from debt service, paying it from TIF, and thereby building up your debt service balance when you've actually levied two resources for the same debt. So large balances in debt service funds, they don't make any sense. Should be kind of a red flag that something's going on that you need to take a look at, and it could be related to TIF. On the other side, deficits in debt service funds don't make a lot of sense either. So if you have a deficit, which we've seen as well, one thing that might be happening is maybe you have some GO bonds that you have certified for TIF reimbursement. You know, in a city, the statute requires you make those debt payments right out of your debt service fund, and then you need to transfer from TIF to debt service to cover that debt payment, and some places forget to make that transfer. So your TIF fund balance increases and your debt service fund balance tends to go into the red. So just kind of watch that. The next item is not repaying interfund loans, and this we see quite often actually. We've talked about interfund loans before, and the issue with making sure you repay your debt service fund if it's taking care of some GO debt. Same concept. If you've gone through the process, your council has approved formally an interfund loan from whatever fund, it could be water, sewer, it could be your TIF fund. As those dollars are generated and they come into your TIF fund, you need to remember to make those transfers to sewer or whatever fund that you borrowed from to repay those interfund loans. And as I mentioned earlier, it's important that you track the balances of those loans, those original loans, what's been repaid and what's still outstanding, so you know how much you need to continue to transfer. So if you're, you know, we've seen too where we'll have a water or sewer fund that's dipping into a deficit, and again, if you look into that, sometimes it's tied to TIF because they've loaned money for a TIF project and that repayment isn't happening. So make sure you're getting your interfund loans covered. All right, the next item, interest portion of debt not certifying that. The statute passed recently actually comes out and requires that when you're certifying your debt that you capture any interest negotiated on that debt, no matter what form of debt it is. Even internal loans, you can repay those with interest, but you need to make sure that you're certifying both pieces. If you don't, and you're paying those from your TIF fund, obviously at some point you're not going to have money in your TIF fund to service all of your debt. Next item, interest earned on TIF funds, not getting that credited to the TIF fund. Again, the new legislation comes right out and requires that interest earned on your TIF fund go back into that fund to be used for purposes allowed in your TIF fund, which is repayment of debt. Also, I think Ted mentioned earlier, if you sell an asset that was purchased with TIF funds, you're required to put those proceeds into your TIF fund. And those are to be used to help service the debt that you have outstanding that you've certified. So the obvious next step to that would be to decertify any interest or sale of asset proceeds that you've put into that fund, because those represent dollars that can help you repay your debt that you do not need TIF dollars to be collected to cover. How often do you need to do that? I would think decertifying once a year. You sit down when you're doing your Form 1 certification and do your Form 2 if you're planning to do that, and then make sure you're doing a Form 3 where you're decertifying those extra dollars that you need to from interest and proceeds. The last item that I have here just talks about Debt previously certified, you repay that debt from sources other than TIF. Typically the situation is where you've refunded some debt. That's where we see this most often. The thing you need to remember is you need to decertify that original debt, the portion that was refunded. If you don't, then obviously you're collecting TIF revenues. For one source of debt, you're double collecting your TIF revenues if you don't get that decertified. So lots of things to think about. You can kind of see where there's just a lot of things to comply with, so a lot of room for making errors if we're not being careful with things. So with that, I think we're going to turn it back to Cindy, and we're going to try to cover some of the questions that we've gotten through.
Thank you, Marlis. We have received a couple of questions through the email process. We're having some difficulties with the normal chat that would be in the webinar pane on the left-hand side. It's really a pain today because it's not working. But again, if you send me an email with your question at ckendall@iastate.edu, then we will get those questions put before our panelists here who are ready to answer our questions. So at that, I will turn it over now. Andy Nielsen with the State Auditor's Office will be taking our first question that has been sent in through the email. Again, that is at ckendall, Kendall, @iastate.edu. Okay. Are you ready, Andy?
Am I on? Can you hear me? First question deals with you might have a urban renewal area, urban renewal plan that has an area, but there has been no ordinance to divide revenue. And the question is it necessary to include this in the House File 2460 report? And first of all, this is a question that's going to be answered during the October 11th and October 25th sessions. But in meeting with bond counsel, their inclination was yes, House File 2460 does apply. If you go to the bill, House File 2460, if you go to Section 5, 3A, it says each county that had an urban renewal plan and area in effect at any time during the most recently ended fiscal year shall complete for each urban renewal plan and area and file with the Department of Management an urban renewal report by December 1 following the end of the fiscal year. So this is exactly that type of situation. You're not getting any revenue. You haven't done a revenue dividing ordinance, but you do have a plan and area in effect. So this does apply. Now, the second part of this question says, well, we're not going to be able to use the report that's out there to do this. And since the web-based program will not display an item on this for that particular plan and area, and the reason why it doesn't display on the web base is because the tax district has not been set up since there has not yet been an ordinance to divide revenue. The best advice we have at this point in time, and we'll confirm this on October 11th, is we recommend that you submit paper documents to the Department of Management. It'll be a very short report because you're only going to be sending in support for the plan, the area, the map, and any of those related documents, but will have to be done on a paper basis as opposed to being able to file it on a web base, because it will not show up on that particular web-based program. The second question that we got dealt with do interest earnings and proceeds from property acquired with TIF debt have to be used to reduce certified TIF debt? And the answer to that, and Marlis answered part of that question, she dealt with the interest part of it. The question went on to add the the sale of assets, land or whatever in the TIF area? The answer to that question is yes. If you look at the new TIF bill 2460, new subsection 10A, which is now a new subsection under 403.19, says interest or earnings received on amounts deposited into the special fund created in this section and the net proceeds from the sale of assets purchased using amounts deposited into the special fund created in this section shall be credited to the special fund and shall be used solely for the purposes specified in this section. So it's pretty clear from the new law that was effective July 1 of 2012 that is the case. The third question that we got deals with kind of some timing issues, and it deals with kind of does a project have to be encompassed in the plan before it can be done? 403.5 subsection 5B is being amended and states this: municipalities shall not approve an urban renewal project for an urban renewal area unless the governing body has amended or modified the adopted urban renewal plan to include their urban renewal project. So in other words, you have to have the plan has to have provisions in it in order to be able to specifically say that that project is part of that plan before you can move forward with that. I know Bond Council has dealt with that. I know I've seen some sample resolutions that they're putting together that cover that point, making sure that the project is tied back to the plan before before you move forward with it. So that's the third question. We have another one coming. The question is, if interest in prior years has not been decertified, should we decertify those prior years this year? And the answer to that is yes. That's although the law now specifically provides that, that's something that if the interest was put into that fund, it makes sense that it should have been certified in the past as well. It's very similar to the example that Marlos was talking about earlier with the debt service fund. The debt service fund interest stays in there and used for the purpose of that fund. So that's a consistent answer. I think we're in the process of receiving another question now. As soon as we get that pulled up, we'll try to answer it. Okay. Excuse me. The question is, what happens if the original total debt certified on Form 1 is not correct? How do you correct Form 1? It depends. Okay. Let's say that in the past, prior to 2006, I think there was a fair amount of confusion of whether or not interest on TIF debt would be certified as well. So if the error was that the total debt certified did not include the interest, you need to go in and certify that interest at this point in time. And you might say, okay, well, we can't. You might say, okay, the law now provides a provision that says we can't recertify debt. Okay, you're not recertifying debt in this case. You're certifying interest that was not previously certified. So that's the one side of it. The other side of it is if you've got something on Form 1 that's included in certified debt that is too high, you'd use Form 3 and decertify the amount that would be necessary to get it down to the correct balance. Okay? Do we have any more questions?
We're checking right now. We do have some questions that are coming in that will be requiring some additional research, and so we appreciate you giving us your contact information, and we will again be contacting you directly with those responses. The other thing that I might interested with at this point is that we will be preparing a Q&A about the various questions as well as some of the high points of the presentation today, and that will be available to all the participants. We are recording this webinar, so when the recording is completed, it will be posted, and that information will also be made available to you if you want to re-listen to it, or maybe you had some difficulties with your technology, you may have missed something, or maybe you got that interruption that we always try to avoid. But this will give you an opportunity to see this and possibly to listen to it again. Hang on a second, we're getting more questions coming in.
Hello again, this is Marlis Gaston again. The question we're getting is, I have a city that had a balance in their TIF, so they borrowed from it to pay for a water tower repair. They certified the debt, however, when the debt was paid off and decertified the debt, it was not the same amount. What can I as county auditor do? Well, I'm not completely sure I'm understanding the question, but if an entity has a large TIF balance, as we talked about earlier, and they borrow from that through a formal interfund loan, then you would certify that interfund loan as TIF debt, put it on Form 1, and then as the TIF taxes come in, you would repay that loan. So from that process, I guess from the question, I'm not really sure what portion needed to be decertified in that situation, because you created new debt and certified that debt. If you did that appropriately, then and then repaid it. So thereby replenishing the TIF fund for what you borrowed. So then that fund's made whole again, and those funds are available once again to service the debt that's already been certified. Okay. All right.
Hi everyone, this is Carrie Johnson with Department of Management. There was a question submitted about having an original urban renewal area that has since been amended to add contiguous areas. The individual indicated that they treated this as one area, and the question is this correct, or do we have 4 areas which require 4 separate certification areas? To that individual, I just recommend double checking with your county auditor as far as whether or not you and the county are all on the same page and tracking this as one urban renewal area that has been amended 4 times. So to that question, I'd say just double check. It is certainly possible that you would have an urban renewal area that's been amended. The whole area is treated as one area with 4 pieces amended, for instance. But I'd say just double check with your county auditor and make sure you guys are both on the same page with how that's being treated.
Okay, we have another question coming in. Andy's going to come over and read this.
Okay, the question is, can TIF funds be used for fees each year for the TIF report updates prepared by an outside company? If so, how do you show the fees on the report to capture the income? The answer is yes. You can probably. I think this would fit under the administrative portions of that the TIF law provides. However, those fees should not be paid directly out of the TIF fund. Those should be paid out of another fund, and then you certify that you create the debt, certify the internal interfund loan, and you would then you would certify that. The TIF taxes would be divided, and then you'd repay that interfund loan. I think we have a couple other questions coming here. What do you do if you have internal loans that have been certified but not approved by council? Can you get approved after the fact right now by resolution, or decertify the internal loan? If you have an internal loan that has not been that have been certified, then it's okay. Part of it depends upon whether it happened before 2006 or after 2006. If it was certified prior to 2006, there was no requirement to have the date the council approved on the forms. So I'm assuming that it's after that. If it's approved, if they've been certified but not approved, I would go ahead and close the circle on that and have the council approve it. But then you would not certify it again. Another question. Do you have a sample resolution for claims to be considered TIF debt? I think we do not have. Marla says that she has one that that we could share with the person asking the question here and make available. Okay. We are having a number of other questions. Okay, this question's one that you probably need to talk to TIF counsel on. There's a 10-year sunset for residential start after the first certification to the county auditor, and I do not remember the exact language on that. I think there's some specific language that deals with that. So please talk to your legal counsel on that. Next part, I've not been. Let's go back to that, please. I've not been putting TIF interest in my TIF fund. Should I go back to the beginning of my TIF and correct the prior years? I probably would not do that at this point in time. I would start from here and start crediting interest to that. Okay, what do we have for the next one? Oh, let's go back to the fees. Somebody. Okay. Can TIF funds be used for fees each year for a TIF report? The answer is that is under administrative provisions of 403-19. I believe yes, they would qualify. How do you show the fees on the report? Okay. Specifically, under the House File 2460 report, we'll be showing you that in the next two sessions, and I think it'd probably be a little bit too confusing for me to try to explain that right now. But essentially, what happens is you pay it out of the general fund, and then what happens is you certify that the council certifies that as or considers that and pass a resolution to create the TIF debt. That TIF debt gets certified, and then you collect the funds and pay off that interfund loan. Okay. Okay. Let's go to the next one. Okay. Here's another question on what are we going to do with if in prior years we didn't put any interest in the TIF fund, are we required to go back? And I would not suggest that. You're not dealing with a lot of money. Let's just get it right going forward. Okay. I think I might pass this one back to Ted, basically the question, I'll let him read the question. I thought I heard the gentleman at the beginning of the presentation state that urban renewal plans could no longer be amended to include new activities. Could this be explained more?
The answer to that is that you can still amend your urban renewal plan. The part that can no longer be changed without affecting the area on a whole is the designation as to whether it's for slum and blight mitigation or it's an economic development urban renewal area. You would have to start from scratch on that. It would affect the entire area. You'd have to set up the area again under a new designation, and that's coming from House File 2460. But you can always amend your urban renewal plan. And it'll be just another moment. We're getting more questions and we're reading through them here.
Okay, the next question is, my city council is considering discontinuation of our urban renewal district and collecting debt via debt service instead. If we do move ahead on this, we won't have any more debt to certify for our TIF. Will we need to certify anything by December 1? And what would be the date my city council would have to act on this discontinuation? There's a lot of issues that you're going to have to look at before you get into this. I strongly advise you talk to legal counsel. There's two of the pieces that you need to consider is even though you might take action and be able to do all the steps that you need to by December 1 of this year, you're still going to have to file the House File 2460 report for the year ended June 30, 2012, which is due December 1 of 2012, and you're still going to have to do the one for next year. So you're going to end up doing the two of those reports anyway, even if you would discontinue it today. So you might want to take a look at that. You would also have to make sure that your timing's right in terms of decertifying the TIF debt and making sure that you're set up so that, number one, you have the authority to levy debt service, but number two, that you get the timing set up so that you have the money to do it. So, but there are a lot of issues in that. I just scratched the surface on it, so please do talk to your legal counsel on that. We're checking on another question here. Okay, the question is, our larger cities have many rebates going on in their many TIF areas. Is it wrong for us, that is the auditor's office, to use the form without rebate tracking and let the cities track the rebates themselves? And the answer to that is no. And the key is that you have to know what certified debts that you have, and the form makes it a little bit easier, but do you have to do it that way? No. Okay, next question. Okay, very good question. If there are no changes to your certification and you just want the county to collect as they have indicated on the last reconciliation, that is, there's no new debt or no decertifying, do you still have to send in the form? And the answer is no. The TIF certification process is very similar to the resolution for debt service for a GO bond. When you sell a GO bond, you do the council or board of supervisors does a resolution which directs the county auditor to levy taxes until the debt's paid. And that's basically the same thing that the certification is doing for TIF. So nothing additional would be necessary. You might want to, just to close a communication loop, you might want to jot the county auditor a quick note and say, we have no changes, so we're not sending the certification in this year. Okay, question is, are land sales in TIF districts required to offset debt within the related TIF district where the land sale occurred? And the answer to that would be yes. Previously, cities were allowed to use land sales for any purpose and did not have to decertify debt in the TIF district. Well, I'm not sure that that was really even true in the past. I think there may have been some interpretation in that manner, but I'm not sure that I think it was really have meant to have been that all along. So again, land sales should reduce should offset TIF debt in the district where the land sale occurred. I think we're getting caught up here a little bit. Okay. Question is, what dates are we supposed to use on our certification papers? Okay, the certifications. Let me consult here a second.
Hello again, this is Marlis again. The question is, what dates are we supposed to use on our certification papers? The last fiscal year, November to October. Not completely sure if you're talking about the date of the form itself at the bottom, but these certifications are due December 1, so you're really looking at costs and debt actually that you've incurred from the last certification, December 1, to the current certification. That's through November 30. So if you're looking at the time period for the debt, what debt you put on your certification, say for December 1, 2012, you'd be looking at from your last certification in December 2011 through this one, what new debt did you incur? If you're talking about the approval date on the form, that's the date that the debt itself was actually approved. So if it's whatever form of debt it is, if it's GO bonds, it's the date your council approved those bonds. If it's an interfund loan, it's the date your council approved that interfund loan resolution. So it's, and remember that with few exceptions, that date, the approval date for your debt that you're listing, should typically always be a date that falls from the last certification date through the current one. If you're putting an old date on there, make sure that you're properly certifying that debt, that you're not actually recertifying previously certified debt. If you have the situation Andy talked about where maybe you certified the principal at one time and forgot to do the interest, so 3 years later maybe you realize you didn't do the interest piece. So that might be a situation where you're going to certify the interest on Form 1. You're still going to put the original approval date on that debt. That's a reason that that date can vary from those date ranges that it should typically be. So, okay, we're getting another question here. Should interest be listed in the TIF fund, the debt service fund, or both? Well, the new TIF statute requires interest earned on the TIF fund be credited to the TIF fund. So obviously, whatever you allocate to that fund, whatever method you have for allocating your interest, you're going to want to put that in the TIF fund. Chapter, I believe it's 12B.7 of the Code of Iowa states that interest earned on funds that you are accumulating to repay debt, that interest has to go to that fund to be used for that same purpose. So you'd also be allocating or be required by statute to allocate interest to your debt service fund. Okay. Hang on, we're checking out the next question.
Okay, this is Andy again. What happens to the dollars if a TIF debt has been paid off many years ago and then a piece of the property is sold in recent times. And I think that there's a bunch of factors that you have to look at in that particular situation. Number one, do you still have an active TIF area and TIF district? If you do not, and you don't anticipate anything ever happening in that area again, then I think House File 2460 amends Chapter 24.21, and it says if you have money sitting in that fund, the TIF fund, that money would end up going back to the county treasurer and be reapportioned to the various tax districts in the county. Okay, we have another question. Can we certify the paying agent fees also in addition to the principal and interest? And the answer to that would be yes. Any of the debt issuance costs that you have would be appropriate. Assuming that they're for the TIF project, they would be appropriate TIF expenditures. Now, the question with that is a little bit, you have to look at it. Where are you paying those from? It might be the situation like we talked about in a few minutes ago, and I have to apologize for backtracking just a little bit. But we're getting these live, so we're not having any time to think about them. Hardly any time to think about them. So if you'll bear with me just a second, let me process this. You're going to be paying agent fees from some other place. So basically what you're going to do is you're going to pay them from some place. You're going to create the interfund loan, which is a debt. You're going to certify that debt and go through the process you're going through. So yes, you're going to be able to certify them, but there are a couple additional steps there that you're going to have to take. Does that make sense? Okay. We can move on to the next one. Okay. I guess we're waiting for questions at this point. I'll turn it back to Cindy.
Okay, so we still have a few more minutes that we can take questions. Send the question in an email to ckendall@iastate.edu. And as long as we have our panel together, we'll take just a couple of more minutes before we sign off. In the interim, I would like to do a little sales pitch for the next two webinars that we have coming up. One will be on October 11th, and the other one is on October 25th. Those will both be the same session. The same information will be disseminated. However, as you know, any question and answer period that we would have may come up with some unique information. So we're not advocating that you participate in both, but we will be doing the same recording of those sessions, so they will be available on the League's website, and you should be receiving a day or two before the webinar, you'll be receiving an email with a link which will again give you the handouts and the presentation slides in advance so that you can have them prepared for those presentations. Again, that will be on October 11th and on the 25th, and those will both be the same information. We have got one more question that's coming in here. The question really refers to next session on the tax increment financing reporting forms, and yes, those forms are being developed and they will be available. Stay tuned to that next webinar and we'll give you the full details on that information. Okay, here's another question coming in.
This is Andy again. Our auditor has indicated the TIF debt to be paid. Okay, let me start over. Our auditor has indicated the TIF debt is to be repaid directly from the TIF fund, not transferred to the debt service fund for payment. In this case, for GO bonds. Is this not correct? The answer to that is that I believe you should transfer from the TIF. If it's a GO bond, Chapter 384.4 requires the resources to be moved to be transferred to the debt service fund and then pay the GO debt from the debt service fund. So that's the statutory answer on that particular item. There is a new provision in House File 2460. It is subsection 10B, which is amending 40319. And what it says, monies in the special fund created in this section shall not be transferred to another fund of the municipality except for the payment of loans, advances, indebtedness, or other bonds that qualify for payment from the special fund. So this would clearly be indebtedness that does qualify for payment, so there's nothing wrong with transferring that. Okay, next question. I just want to clarify that if you collect excess TIF funds from a specific urban renewal area and you paid off all debt attached to that specific UR area, you can either assume you forgot to decertify some of the debt prior to the final year of collections, and in that case you should appropriate the TIF back to the county auditor to be reapportioned to all the taxing districts, or use those excess TIF collections in a second separate established UR area to repay debt in the second separate UR area. And you got the answer, the number one is the correct answer on that. If you're done in an area, you need to appropriate or send those TIF dollars back to the county treasurer to be reapportioned to all the taxing entities. And that is covered in, let me find the section for you. It's in the amendment, it's in section 4 of House File 2460 on page 2. It's the last paragraph that was added to chapter 24.21 of the code, or section 24.21 of the code. Okay, I think we might be caught up again. I'll turn it back over to Cindy. Thank you.
Well, since we do not have any more questions coming in, I think that we will conclude this morning's webinar, and we appreciate your participation, and we hope that the information was beneficial to you. Again, we have been recording this, and it will be available on through an email that I will be sending you with the link for the recording, and we will also be sending a number of emails concerning the webinar scheduled for the 11th and the 25th, giving you the handouts and the presentation in advance. So you'll be seeing a number of emails coming through. We've got one more that came in. Hold on just a second.
This is a follow-up to a previous question, but you have a TIF area that's still active, and can the dollars used for can dollars be used for other TIF projects within the area? The original question was what happens to the dollars if the TIF debt has been paid off many years ago and then a piece of the property is sold in recent time. And I think this is a situation that I would recommend that you get with bond counsel on this. I don't think that the answer is extremely clear on. It's obvious that if you have some TIF dollars that are coming back and you're not going to do anything in that area, it goes back to the county treasurer for reapportionment. But it's not as clear in the situation that's given in this particular question. So, very good. Thank you.
Well, now we will conclude our webinar for this morning. And again, thank you for your participation. If you have any questions, feel free to go to the Department of Management and to the Auditor's Office, and also to your bond counsel. It's important that you keep that communication open to make sure that these things are being certified correctly. Thank you again, and we'll talk to you probably on the 11th or the 25th. Good day.